Hey everyone, listen up. Just this week, a core engineer at XI named Sumang Kori suddenly quit. To most people, this probably looks like just another regular personnel move. But from where I'm sitting, this is a massive fire drill for Elon Musk's balance sheet. Just a few days before Sumang vanished, he was on a podcast interview and got a little too excited and unguarded. He let two sentences slip, and those two sentences basically flipped over the 10-year valuation model Wall Street has been using for Tesla. Sumang didn't leak some boring product specs. He leaked Musk's ultimate trump card against Microsoft and Google. He explicitly said that they plan to pay car owners to rent out their car's idle computing power while the vehicle is charging. He said they don't need to build massive data centers anymore because the computing power is already on the street and in your garages. The moment he said that, every analyst clutching an Excel sheet to calculate Tesla's value felt their hands shake. We have been making a massive pricing error this whole time. Think about how the market currently views Tesla. It's still seen as a car manufacturer. The underlying logic is a one-time manufacturing business where you sell a car and make a profit. But Sumang's leak completely swaps out the nature of Tesla's underlying assets. Keep this number in mind. As of right now, Tesla's cumulative global sales are approaching 7.9 million vehicles. To a traditional analyst, those are 7.9 million customers who need after-sales service. But in the eyes of an XI architect, those are 7.9 million deployed mobile server nodes equipped with top-tier AI chips, their own power supplies, and cooling systems. If this logic holds, Tesla's competition instantly shifts from Toyota or BYD to Amazon AWS. The former is a manufacturing grind with a 30x PE ratio, if you're lucky, while the latter is a cloud giant collecting rent with a PE starting at 50x and no ceiling in sight. That massive valuation gap is exactly why Sumang had to go. If this shift in asset nature gets exposed too early, it won't just bring an SEC probe into related party transactions. It will completely mess up the board Musk has set for his $100 billion gamble. Today, we are doing a Wall Street-style audit. We are leaving emotions behind and just doing the math. We need to figure out if this supercomputer made of 7.9 million nodes is a $1 trillion value Musk pulled out of thin air. Before we dive into the technicalities, we have to ask the fundamental business question: why now? Why is Musk reaching into car owners' trunks right after XAI raised $6 billion? The answer is brutal. It's because he is about to lose the conventional computing arms race. Look at what his rivals are doing. Sam Altman at OpenAI is pushing the Stargate project with a budget of $100 billion. Microsoft, Google, and Meta are like machine gunners with infinite ammo. They can buy up all of TSMC's capacity and fill server rooms the size of football fields without caring about the cost. And what about Musk? He might be the world's richest man, but that's stock value, not cash. EXAI's $6 billion is nothing in a $100 billion infrastructure war. If he plays the game the standard way, buying land, building centers, buying H100 cards, his cash flow would be incinerated instantly. Even if he wanted to buy them, Jensen Huang at Nvidia might not even have stock for him since Microsoft already called dibs on the production. In business strategy, when you face a dead end with absolutely inferior resources, your only chance is asymmetric warfare. You can't compete on who buys more cards. You have to compete on who has higher asset utilization. This is both the tragic core and the business genius of Musk's move. His only chip is those 7.9 million cars already sold. In finance, this is called zero sunk cost. For OpenAI, every new batch of computing power requires cold hard cash for hardware. That is a massive marginal cost. But for XI, the hardware cost was already paid for by the car owners. Sumang's leak about zero capital expenditure is essentially Musk using a hidden maneuver in a desperate situation. He is trying to prove that in this age where computing is king, the winner isn't the one with the most cards, but the one who can squeeze every drop out of idle assets. So how does the math actually work? How crazy is the cost advantage of this distributed power compared to traditional data centers? And more importantly, as an owner or a shareholder, what role are you playing in this massive migration of computing power? Are you a beneficiary getting a free ride, or a digital miner being quietly harvested? Let's pull out the calculator for some hardcore capital efficiency. We will compare the unit cost of computing for OpenAI versus XI, and the conclusion will completely change how you see the AI war. When we say Musk is launching asymmetric warfare, it sounds like a military term. But on a financial statement, it's just a math problem about capital expenditure efficiency. To see the cold reality, we need to put the cards of OpenAI and XAI on opposite sides of the scale. On the left is the heavy asset trap OpenAI is stuck in. For Sam Altman to keep his lead, every bit of growth must be paid for in cash. To train a GPT-5 level model, you're looking at NVIDIA H100 cards that cost $30,000 each, and hardware lists for clusters that start at 100,000 cards. And that's just the start. From getting land to building the center and waiting for power infrastructure, the cycle is 18 to 24 months. Tens of billions are locked up during that time. And once the hardware is on the ground, depreciation starts eating profits like a countdown clock. That is why OpenAI is so desperate to commercialize and go public. They are sitting on a giant cash furnace, and stopping means death. On the right side of the scale is a light asset heaven built by XAI. When Musk needs power to train Grok 3, his hardware capital expenditure is zero. This sounds like it defies business logic, but it's the magic of externalizing sunk costs. The expensive HW 4.0 chips in those 7.9 million cars were paid for by consumers the moment they took delivery. Musk doesn't pay rent for land or maintain complex industrial cooling systems, because those costs are scattered across millions of private garages. So what does XAI actually pay for? Suman mentioned paying owners, but knowing Tesla's cost control logic, this will likely be non-monetary, like supercharging credits or FSD subscription time. The marginal cost for Tesla is almost zero. This is the highest level of cost arbitrage in financial engineering. If XAI's unit cost is 1/100th of OpenAI's, Musk has absolute destructive power over pricing in the future, AIA, PI price wars. While Altman is carefully pricing things to cover hardware depreciation, Musk can easily undercut the competition's bottom line. This is a massacre of zero marginal cost. He isn't just destroying a competitor's product. He is destroying the financial model they need to survive. Now, to all the Tesla owners watching, you might want to rethink your position in this game. This isn't just about your car's value going up. This involves a deep issue of business ethics and role reassignment. The core sensitivity of Suman's leak is that it shows Musk trying to unilaterally change the nature of the transaction. For a century, the logic was that the owner is a consumer. The deal ends at delivery, and the ownership and depreciation risks move to you. But in XAI's grand vision, the owner is redefined as a supplier of distributed infrastructure. It looks like an upgrade to the sharing economy. But there is a huge information asymmetry hidden inside. We have to ask three questions. First, does the credit compensation cover the energy cost and battery wear and tear when those chips are running at full load for AI training? Putting legal risks aside, from a strategic level, Musk is building an unbreakable moat. Where is the weak point for OpenAI and Google? It's the supply chain. If TSMC capacity is tight, or Nvidia raises prices, or geopolitics cut off high-end cards, their expansion suffocates instantly. But where is XAI's weak point? It doesn't have a single one. Its power is scattered across power grids in over 100 countries and millions of private garages. No single supplier can choke him, and no local power shortage can paralyze the network. This is what Nassim Taleb calls anti-fragility. While competitors are building higher walls around centralized data centers, Musk has already seeped his moat into the capillaries of the physical world. This operation of turning physical assets into a digital moat is a rare mutation in business history. The strategy is logically flawless and incredibly resilient. But for us, this complexity also makes the risks very hidden. We have to admit that in the face of such a massive narrative, individual judgment often has blind spots due to the information gap. To help calmly break down these governance risks and regulatory triggers, I have put together a computing power arbitrage tactical pack, which I've linked in the comments for you to grab. But does owning the power mean winning the AI war? No! Power is just the muscle and the fuel. To really take a bite out of Microsoft and Google, you need a superbrain that can take over human workflows. The second secret, Suman leaked the project with the dark humor codename Macro Hartis, the crushing blow Musk has ready for the software empire. It's not just a new AI app. It's a dagger aimed right at Satya Nadella's business moat. He wants to subvert the SaaS subscription model that Microsoft lives on. We are going to reveal the true face of Macro Heart and see how Musk plans to use GUI technology to bypass API monopolies and kick in the door of the software industry. Welcome to the Iron Bull Finance channel, where we help you read the global trends and stay ahead of the curve. We know XI wants to use the Macro Heart dagger to pierce Microsoft's lines. Some people think the name is just a joke, but in business, a name is often a destiny. Macro Heart exposes XAI's ambition. It doesn't want to be software running on Windows. It wants to be the new operating system sitting above all software. We mentioned GUI technology gives AI the ability to kick in the door. This isn't just a technical difference. It's a redistribution of software sovereignty. Once XAI's digital employees can take over a screen through vision, giants like Microsoft, Salesforce, and Adobe instantly lose their exclusive access to users. You used to be stuck with Office because you needed the interface to work. In the future, you just give orders to Macro Heart. The AI will operate Office in the background in milliseconds. For the user, Excel becomes an invisible, replaceable piece of digital scratchpad. For Microsoft, they get demoted from the center stage rent collectors to background drivers that nobody cares about. This is Musk's endgame, turning the trillion-dollar SaaS market into a free backend for XAI. The most lethal part of this isn't the tech, it's the math. This leak showed an insight that is core to XAI's philosophy against GPT. In the enterprise battlefield, speed beats reasoning. The AI industry is currently obsessed with reasoning power, trying to build an Einstein. But based on the Macro Heart logic Suman leaked, Musk knows exactly what bosses actually want. A boss doesn't need Einstein to fill out expense reports or organize meeting invites. They need a super intern who has insane hand speed, never gets tired, and has no emotions. Let's do the efficiency math. A human employee might take 30 minutes to process a complex cross-department report, with coffee breaks and texting in between. But a Macro Heart digital employee doesn't need expensive APIs. It operates on the screen at 8 times human speed and finishes in 10 seconds. For a business owner, this isn't just a reason to cut staff. It's a reason to rewrite the procurement list. If AI can perfectly operate free web-based tools, why would a company pay millions for enterprise software subscriptions? The foundation of SaaS charging per head will collapse. In the future, companies won't buy software rights. They will buy AI execution power. That is what Microsoft fears most. Musk isn't just stealing their users. He is erasing their business model. You might be cheering for Musk's strategic genius here, but as an investor, we must be extremely wary of the bottomless risks beneath our feet. Suman wasn't just fired and blacklisted because he leaked a roadmap. The deeper reason is that he exposed the most fragile legal weakness in Musk's empire. Look away from the tech for a second and look at corporate governance. Tesla is a public company. Its money, power, and data belong to all shareholders. xAI is Musk's private company. Its profits belong primarily to him. This leak confirms that Musk is performing a massive blood transfusion of computing power, dumping Tesla's existing resources into xAI and using Tesla's fleet data to train Macro Heart's vision. Under the SEC microscope, there is a very ugly name for this: related party transactions. It's like being the president of a public bank and secretly using the depositors' resources to feed your private lending company. Even if you argue it's for ecosystem synergy, it's a violation of the rules. Suman's naivety was thinking he was telling a great story of innovation. In the eyes of a Wall Street lawyer, it's a perfect script for a class action lawsuit. If Tesla shareholders feel their interests are being drained by xAI, this trillion-dollar game could be forcibly shut down by regulators. So how do investors price this huge compliance risk against the business temptation? Is Tesla's stock undervalued because of xAI or overvalued because of governance risk? For the final part, I'll give you a rational investment framework. I'll tell you how to read the cards in this foggy game before you decide to stay at the table. If we just look at the business logic, Musk's distributed power and Macro Heart are god-tier moves. But in the capital market, there are always two sides to the coin. When we cheer for this rule-breaking genius, a professional investor's first reaction shouldn't be excitement, but caution. Suman's leak accidentally opened the most hidden and dangerous governance crack in Musk's empire. Look at the legal nature of these two entities. Tesla is public. Its every car and chip belongs to the shareholders, including you and the big pension funds. xAI is private. Its future belongs to Musk personally. Based on the leak, Musk is connecting them, funneling resources from the left hand to the right. In the context of corporate governance, this is a very sensitive gray area. It's a pricing puzzle. If xAI really uses the power of 7.9 million Teslas, how do you bill it? If xAI pays market price like Amazon AWS, its cost advantage vanishes and the zero-cost loop fails. If it's an internal subsidy where xAI pays almost nothing, it's legally seen as a public company bleeding out to a private one. The deep logic of Suman's firing is that he thought he was describing a technical utopia. But to an SEC prosecutor, every detail about not needing new data centers and using idle power is a hint of profit shifting. Tesla carries the hardware cost and battery wear, while xAI enjoys the soaring valuation of model training. This is why Wall Street is so split. The bulls see the compound effect of tech synergy, while the bears see the potential legal costs. Once a lawsuit or a regulator demands a business split, this $100 billion loop hits a physical wall. As investors, we can't just look at PE ratios or delivery numbers. We have to introduce a higher dimensional factor, the governance discount. This is the valuation cut the market applies because of uncertainty in the corporate structure. For Tesla, this discount is an objective fact. This creates the ultimate paradox. From a business view, the tech gives Tesla cloud service potential like AWS, which is a huge premium. From a governance view, the structural risk adds a discount. The stock price is the result of these two forces fighting. It's not a simple buy or sell. It's a risk pricing question. You have to ask if Musk's disruption is big enough to cover the governance noise, or if the compliance costs will swallow the innovation. There's no standard answer. But understanding this puts you ahead of 90% of retail investors. You start thinking like an institutional player, looking for that balance between an empire's ambition and the market's rules. In the end, we have to see the fundamental truth. Tesla has completed a species jump. If you're still looking at quarterly deliveries or gross margins per car, you've already lost. In Musk's new game, Tesla is no longer a manufacturer. It's a central bank of computing power with the right to issue its own currency. Those 7.9 million nodes are his printing presses, and xAI's algorithms are his gold reserves. While traditional car companies are stressing over inventory, Musk has left that world behind. He is doing something never seen in business history, making a sold product turn back into a production tool for the parent company. It's like Nokia was making money on hardware, while Apple started collecting rent via the App Store. Tesla's moat is no longer the battery or the motor. It's that global, zero-margin, all-costs computing grid. So how do we look at the chips in our hands? My only advice is this: don't buy Tesla as a stock. Buy it as a call option that never expires. Traditional value investing looks for certainty. But with Musk, you're looking at possibility. It's a binary bet. Side A, Regulators move in on the transactions and the stock price collapses back to manufacturing logic. Side B. The loop works, and Musk becomes the global monopoly for computing infrastructure. With a market cap over 3 trillion or even higher, there is no middle ground. The premium you pay today isn't for his present, but for a ticket to the age of computing hegemony. The wild swings you endure are just the governance tax you have to pay. The cards are on the table. Do you walk away because you hate risk? Or do you bet on the man who always beats the rules? Go all in, or don't. It's not about the financial reports. It's about your worldview. By externalizing the hardware costs of 7.9 million cars, Musk has rebuilt a manufacturing company into an energy and computing central bank with global distribution rights. The crushing blow macro heart deals to SaaS shows high strategic certainty, but that efficiency comes bundled with high legal risk and a governance discount. In this complex period, you can't see the truth just by looking at K-lines or listening to slogans. That's why I put that computing power arbitrage tactical pack in the comments for you. If this helped you see the other side of the market, please give this video a like. It helps other investors see the truth. Don't forget to subscribe to our channel, Iron Bull Finance. When the wind shifts next time, you'll be the first to get the signal. See you next time.